around 5 o'clock, I screenshotted this chart. The trade plan here is to look for short opportunities. You can see the head and shoulder has played out since the last time I wrote that article. Okay, but over here, okay, there's still huge opportunity. Okay, so don't worry about missing out. The key target I'm looking at is $18.515. Okay, so right now, as of this chart here, you see the price is about $23.7. Okay, so the downside is huge. But over here, I have a key level of 22.835. Okay, so that is a key level. Why? Because you can see the head and shoulder. That low there is 22.83. Okay, so that level needs to be broken before we have a high chance of price continuing lower towards 18.51. Okay, which means my take profit will be at 18.51. But I would monitor and manage my trade as price reaches 22.83. Okay, basically COT, if you guys want to understand a little bit more, COT stands for Commitment of Traders, right? It's basically a futures market analysis. Okay, and this is futures market are centralized. Okay, so a bit of background knowledge. Futures market are centralized, which means everybody who buys and sells in the future market, okay, is recorded because it's a centralized market. In the spot market, like our usual FX trading is spot market, is decentralized, which means that your liquidity can come from multiple front, various liquidity provider, various brokers, etc. Okay, but futures market are centralized. So when things are centralized, you can track them. Okay, so the COT report is very good for doing that. The usage of it, basically, we are able to see whether there are a lot of people buying, a lot of people of selling, or no interest in buying or selling at all. Okay, so now this looks a bit complicated. I wouldn't want to confuse all of you. Okay, but let me just bring your attention to maybe a few little things. Okay, now when you talk about overbought, oversold, right? This part here, right? I circle. Okay, this here you can see the non-commercial index. Okay, basically it's an index. Okay, so you can see there's a red horizontal line, green horizontal line. Okay, so basically this is like overbought, oversold. Okay, this is against the Mexican peso. Okay, so you can see here when price drops means that everyone who wants to sell, okay, has already sold, and therefore that's the oversold condition. Okay, so every time it comes down, there's a high possibility you go back up, right? So that's how it works. Okay, and that itself might answer your question on whether the overall market for this particular instrument, the Mexican peso, is overbought or oversold. Okay, there are many other indicators that's running here, but I don't want to over confuse you guys. Okay, but basically, if you want to understand a little bit more, maybe we can do another webinar on this topic called COT report. But wouldn't want to spend too much time for today's webinar. Okay, again, if you guys have any suggestion on topic, right, you know that on the eSmart webinar series, that course module, okay, on the left hand side, there is the suggestion topic, right? We read through them, every suggestion that you guys have, and that's how we also come up with topics for this month in May. Okay, so if this is something that you guys are keen, we can definitely talk about COT as well. And what they think of is just, 60% means that I will win more than I lose. And then they just go in like 5 trades, 6 trades. And if they start to see some losses more than wins, they will come to a conclusion that, this doesn't work. And then they skip and they jump to the next trade or next strategy. Okay. So today I want you to understand that trading is a probability game. And for probability to play out, it's a numbers game. And for numbers to play out, you need a proper sample size. Okay. So over here, I want you to also take note that every trade outcome is random and independent by itself. Okay, so what it means is this. Okay, the last trade that you take, okay, whatever the outcome is not gonna be affecting your next trade. Okay, so last trade, if it's a losing trade, doesn't mean that this trade is going to be winning or losing. Okay, there's no relevance to it. Okay, that is independent. Every trade is random. Okay. If you put them together in a big enough sample size, right, that occurrence will become an organized chaos. Okay, now if you want to understand this a little bit, go and do a simple Google research. Okay, what is organized chaos? Basically means that if you look at things independently, they are random. But if you have big enough sample size to put them all together, okay, there is a pattern. It becomes chaotic, but yet organized. Okay, that's what it meant. Okay, so today trading itself, okay, if you do it in a very small sample size, that becomes random. Okay, your outcome is random. But if today you have a large enough sample size, okay, then everything becomes an organized chaos situation. Okay, so let me just share with you a very real personal thing, right? Over here, I'm sharing with you very recent. This is my result for 2020. Okay, this is purely on FX trading. Okay, trading itself. Okay, so I want you to take a look. This is my January result. That means overall in January, I didn't make money. I lose about close to 0.5%. Okay, of course, not one trade, right? Various trades, a few trades here and there. Some win, some lose, but net on January, I lose 0.5%. Okay, I lose 0.5%. Okay, so I want you to think about this, right? Put yourself in this environment, this context, okay, where you started trading this year in January, you lost. You put in some effort. Definitely, you put in some effort to trade, right? You have some winning, some losing, some winning, some losing. At the end of that month, you lose 0.5%. Okay, how would you think? Okay, you might start to doubt. Okay, is this gonna work? Is this strategy worth considering? Is this strategy worth continue? Trading, putting the effort. Okay, then maybe you start to think, okay lah, let's give it some time, right? Let's give it more time, and then you continue trading in Feb. Okay, and this is my result in February. Okay, I lose. Again, there's a few trades that I took, right? Some win, some lose, and then net at the end of February, I'm down close to 1%, right? About 0.76%. Okay. Now this is the part where you might come in and say, okay, imagine you are me, right? You're experiencing this. February you're down, January you're down. So net for the year in 2020, as of February, 2 months down, you're close to 1.5% down. Okay, and then you might start to think, oh, okay, no, this is not gonna work, right? Then you probably hop into another thing, so you start to search for the next strategy that might give you a better result. Okay, but what happened is, on March, I gained back 2.24%. Okay, so again, it's the same process. Some win, some lose, some win, some lose. But net in March, I gained back 2.24. Okay, now, of course, it's not like wow, a lot of returns. Okay, but this is where I manage my risk. This is my profile, right? So I just want you to see not in terms of the numerical number, okay, but the experience of it. Okay, so the first 2 months was a positive result, but the third month in March, it was a positive one. Okay, and that month actually managed to cover the 2 months of losses. Okay, so overall, this becomes okay, still profitable. Okay, and what I want you to see is that for me, right, when I mean sample size, okay, there's generally 2 ways you can look at it. One is that if you take a lot of trades and then you go by the number of trades, the quantity of trades that you take, that can be your sample size. Okay, for me, my sample size is I look at my performance on the quarterly basis, which means 3 months, 3 months, 3 months, 3 months. Okay, because I don't take a lot of trades. Okay, some of you perhaps know I don't take a lot of trades. Okay, I rather focus on the quality side of it than the quantity. So if I don't take a lot of trades in a month, then it's not fair for me to judge my performance on a month-to-month basis. Okay, so in a month, if let's say I only take 10 trades, okay, then of course it's not a very good number, right? Because the sample size is so small. So if I take a quarter, then on average, if let's say someone 10, someone 15, then at least I have close to like 50 trades in a quarter. Then it's a better assessment because the sample size is bigger. Okay, so this point here, you need to understand that all these things are playing out, and it's not just about what is your win rate, what's your accuracy. Okay, so this part here I want to share with you because some of you perhaps are going through this as well. Okay, this journey of yours, thinking about win rate, thinking about accuracy, how do you assess a strategy? Is this strategy still working, and things like that, right? So hopefully this part here might give you some help, some insights. Okay, and of course, this is my 2019. Okay, you can see that the year started very good, okay, but midway into June, somewhere in June 2019, right, you can see that I had a rather deep loss, right, quite big drawdown. It's about down 6%, okay, and then for the remaining of the year, it's not that fast, okay, it's like not bad, but not as fast at the start of the year. Okay, so over here, I also want to share with you that whatever strategy that you're going to use, okay, eventually there will be that 1 month or a few months that's just going to be bad. Okay, bad means, you might be losing, you might not be performing. You look at my December, it's basically flat. Okay, that can happen. Okay, all strategy will go through that phase. Okay, so the idea here again, if you look at trade as an independent single trade or a single month, that becomes random. Okay, but if you put them together, it becomes an organized chaos. Okay, so this is something I want you to take away, right? Very true for all trading strategies and methods out.
Okay, thanks. I think someone actually answered rental, and it is exactly it, right? So if you have been to shopping malls before, right? You have been to, pavilion and stuff like that, right? It's super simple how they make money. You see tenants like Nike, right? Some of the more famous hot pot restaurant like Hai Di Lao, bubble tea chain like Tea Life, and even Watson or Guardians, right? So these are the tenant of the properties in Sunway Pyramid, right? And what do they do if they want to stay in the property or in the shopping mall? They pay rent to the manager or the administration of Sunway REIT, right? Sunway REIT owns Sunway Pyramid, right? So in order to stay in the property, so this tenant like Nike, like Tea Life, gonna pay a rent to Sunway Pyramid, and in return, after Sunway Pyramid collected their dividends, right, they're gonna pay after Sunway REIT collect their rental, they gonna pay dividends to who? Right, us, right? We are the investors, as example, assuming we invest in Sunway, right? So we are the shareholder of Sunway REIT, and then whenever Sunway REIT collected rental, right, they're gonna pay us dividend, right? So this is how you can profit from real estate investment trust investing, right? So essentially, when you think about it, we invest in the stock market and receive dividends. Simple as that, right? Now, I want to go deeper into why real estate investment trust or REITs, right? Especially this is something that you want to pay attention to, especially if you are looking to build a stable long-term income stream from the stock market, right? You might want to take some notes, right? Prepare some notes with you, write down some questions, or write down some key points, right? Now, why REITs? Point number one, right? They distribute at least 90% of net profit as dividend to investors. As an example, right? Assuming Sunway Pyramid or Sunway REIT, they got 100,000 ringgit net profit in 2019. So they in return, they're gonna pay us as investors, right, 90,000 ringgit, 90% of their net profit, right? So obviously they doesn't pay me 90,000 ringgit, they pay to all their investors, right? They plug a bit, okay, this is your share, right? Plug a bit, okay, this is your share of the profit, right? Number two, because they distribute at least 90% of net profit as dividend to investors, which, ladies and gentlemen, this doesn't happen in other stocks in the industry, right? With this in mind, because of this, they actually give very, very attractive dividends, right? Now, with that in mind, I want to actually show you the chart below, right? So this is the chart that shows you three dividend yield, right, in terms of percentage of three different REITs listed in Malaysia, right? So on the first one, you can see YTR REIT, in the middle, Sunway REIT, on the right, RRK REIT. So for your information, right, RRK REIT are REITs that owns and runs KPJ hospitals, most KPJ hospitals around us, right? So as you can see, because of their distribution policy of more than 90% and also their attractive dividend yield, in a way, they give us as an investors a very, very stable return from year to year, right? So as you can see, this is really not something that a lot of listed company can actually say, right? I give consistent return, right? Not a lot of companies can say that, right? With an exception of real estate investment trust. Now, with that in mind, I also want to show you a comparison, right? The difference in return or yield, right? Return, for those who are new, just think of return as yield, right? Y-I-E-L-D. I use this word interchangeably, right? So it's a same, right? So I want to take this opportunity to actually show you the difference in return between this dividend or interest paid from different vehicles that we are usually exposed to, right? So as you can see from the furthest right, so as some of you might have known, the government has lowered down their policy interest rate, and hence right now it's a very, very bad situation for savers, right? If you put money into your saving account, chances are you would not earn as much as you used to be, right? So as you can see, 2.1% is the latest 12-month FD rate, right? This is from Maybank, right? And not only that, when you look at it, right, EPF, one of the more respectable fund houses in Malaysia, right, give around 5.45% in 2019. Now, as you can see, right, REITs can even pay more or even be very, very competitive with EPF's rate of return, right? So this kind of show you that REITs are actually in a very good position if you want to look for something consistent, right? Something that give you a very, very respectable return, right? It might not be 30%, but who cares, right? 30% can go up and down in a very volatile manner. What if there's something that can give you, again, the caveat, obviously, you need to do your own research, but if you do it right, it can give you a 5 to 8% return on a fairly consistent basis.